So last class we had discussed with, started with the unit 3, financing decisions. We looked at what are the factors affecting the capital structure, meaning and the factors influencing. We looked at various external factors and we also looked at various internal factors. Today we will be looking at the sources of finance. So where does the money, or how does the companies raise money, in what form, right? There are 3 different sources: short-term sources, medium-term sources of funds and long-term sources of funds. So when I say short-term, you remember the money market instruments, all those instruments come under this section, right? Commercial bill, intercorporate deposits, bank overdraft available for only current account holders, factoring. Okay, I hope you remember the concepts of these individually thought earlier, right? Now all these concepts come under the short-term sources where company has to raise funds for working capital purpose. Next comes your medium-term sources, that's maybe 5 to 10 years on the line, or 1 to 5 years down the line of the company. Then the company can go for public deposits options or retention of profits, or you can approach for a loan in the bank called as medium-term loan. Retention of profits, if you haven't known, it is keeping back the profits the company has earned with itself. Basically, I'm not distributing my entire profits to my equity shareholders in the form of dividends, but only a part of it I will divide it or distribute it, and a part of it I will retain it or keep it with myself. Last is long-term sources, where I'm going to talk about the equity shares as well as debentures, term loans and retained earnings. So these are the options for which the companies can raise fixed capital or share capital or long-term borrowings. Okay, now this is a huge sum of money where I can raise through capital market. Remember the primary market, secondary market, stock exchanges, bond market. These are the areas, or these are the sectors from where the companies or organizations can raise their long-term funds or long-term capital. Now, as we have looked at the source of finance, it is equally important for companies to maintain a optimum capital structure, that is a balanced capital structure. Okay. Now, first let's look at what if the company has overcapitalization. So more than what is required for the company. What if the company raises more capital? Let's say the company needs 10 lakh rupees, but the company has raised 15 lakh rupees. Okay. What are the scenarios if there is overcapitalization? On the other side, what are the scenarios if there is undercapitalization? What is undercapitalization? I require 10 lakh rupees, but I only have in my hand 7 lakh rupees. That is undercapitalization, lesser than required. What is overcapitalization? More than what is required. Got it? So let's look at what is overcapitalization. When a company raises more capital than regular for business activity, it causes overcapitalization, as I just told. For the running of my company, right, in terms of fixed and working capital, I require 10 lakh rupees, but then I have overcapitalized it. I have bought, or was able to raise 15 lakh rupees. Now, what is the effect? Now I have 15 lakh rupees instead of 10 lakh rupees. So what can be the consequences in terms of the decision taken up by the management? Now usually it's a psychology, human psychology, right? Now generally as a student, if you can relate to this, I believe, normally if you're receiving rupees 100 as your pocket money, right, periodically, maybe weekly once, etc. Now that's a common expenditure. You plan your expenditure within that 100 rupees budget. Okay, so this is the money you will receive and you can only spend up to 100 rupees. Now all of a sudden, if your parents are giving you 500 rupees, okay, that is beyond your usual spending habits. Correct. Now what you do, because you have so much money in your hand, disposal money in your hand, you will try purchasing things which are not required, right? You start your expenditures are going to increase now rather than your day-to-day regular expenditure. Correct? That's the same scenario happening for companies. Over the normal expenditure over the normal capital, if companies have overcapitalization, how could it badly affect the company's number one, high amount of idle funds? So companies that 5 lakh rupees extra that they have raised or procured or acquired is idle. So I don't know what to do with that 5 lakh amount of rupees. So it's just lying waste. We all know that money is a very vital source for any kind of industry. It's a trading, retailer, partnership firm, any kind of industry. Money is a lifeblood. Finance is the lifeblood of the company. We looked at the first chapter itself. Now, if money is kept idle, is that good or bad for the company? Definitely a bad decision. Correct? So, overcapitalization leads to what? High amount of idle funds. Second, acquisition of assets when prices were high. So, what we companies tend to do is they tend to purchase fixed assets right when the prices are high. Usually, if a company has to purchase a fixed asset, it will look at that time period which is at best. That means the cost of that asset is lesser down. Is that clear? So, I'm going to look and wait for that time period when the cost of the asset comes down in the market, and then I can purchase it. But here in this scenario, what happens is, because I have so much idle funds available with me, I will start buying the asset which is at the price of 3 lakh, right now. Maybe there might be a time period where the asset's price may fall down to 2 lakh 50,000. Okay, so irrespective of thinking what is the price of the asset, high or low, just because I have more money or there is over capitalization, I tend to acquire the assets when the prices are high. So basically, I am not waiting for the time for the prices to reduce. Is that clear? Next is liberal payment of dividends. Now, just because I'm having too much of money or cash disposal at my hand, I try to pay more dividends to my equity shareholders. Liberal means what? Without any restriction, freely, okay? Without any restrictions. Payment of dividends. So, before overcapitalization, when it was a optimum capital structure, I used to pay 100 rupees per head as the dividend per share for equity shareholders. Now, because I have overcapitalization, I am planning to pay 300 rupees per head to equity shareholders. Understood? That is called as liberal payment of dividends. There is no rules or regulations that I am fixing. I am just paying them because I have more money at my disposal. High promotional expenditure. Now, this promotional expenditure is a very important one for companies when they have to promote their products or their services. So, what happens here is, because I have more money with me at a disposal, I try to put that money into promotional expenditure. So, more than what is required promoting my product or my company or my brand, I am spending more into promotional expenditure. So usually, let's say my budget is around 2 to 3 lakh for promotional expenditure, but now I'm promoting more. That means I'm spending around 5 lakh rupees just for the sake of promoting or for promotion of my products or services. Is that clear? When there is overcapitalization, what can be the effects on my company? There is high amount of idle funds, acquisition of assets when prices were high, liberal payment of dividend, high promotional expenditure. There's many more, but just for you to get an idea of the concept, I'm just putting down few points in front of you. Hope you have understood what is overcapitalization and the effects. Moving on to undercapitalization and its effects. What is undercapitalization? When the company does not have sufficient capital, notice that word, sufficient capital, to conduct normal business activities and pay creditors, it is called as undercapitalization. So, I require 10 lakh rupees, but in hand I only have 7 lakh rupees. So, what will that affect in? That will affect my normal business activities. Maybe I can't pay my wages to a to my laborers or to my workers. Maybe I'm not able to buy even a small stationery. I may not be able to procure my raw materials from my suppliers. All these decisions is going to affect my normal day-to-day business. Got it? What are the effects? First one, production is affected. As I told, if there is no raw material, can the production process happen? No. Production process is going to be halted, and therefore I cannot meet the demand in the market. My products cannot reach to the market for sale on time. Because why? My production is halted. Is that clear? So when my products are not reaching to the market, people cannot buy my products. People will quickly shift to some other brand products or services. Understood? So production should not be halted. Reason being, I can lose the market. I can lose my customer loyalty in the industry. The credibility of the company decreases. This is a very vital point. The credibility of any company has always a added goodwill to it or an added reputation to it. Now it's very easy to say so and so company has taken a loan of so and so crores, okay, so much amount of crores, etc. But the point of appreciation is the same company who has borrowed, let's say, 5 crores of rupees has timely repaid back the loan amount. Now, which is a good statement? Taken a loan is a normal statement. Everybody takes a loan. But people or institution who pays back that loans, that means their credibility is high. The trustworthiness of the company increases. Now, in this case of undercapitalization, it is not so. The credibility of the company decreases because you don't have much money to even run your business. How will you pay your creditors? How will you pay your bills payable? You cannot pay. Therefore, your credit worthiness decreases. So people start losing trust with your company because why? Company is not able to make timely payments. Next is conservative dividend policy. We just looked at here overcapitalization, liberal payment of dividends, and here we have conservative dividend policy. Liberal opposite is conservative. Conservative means with restrictions, with rules and regulations. So conservative dividend policy means, let's say I have to pay 100 rupees per head to equity shareholders. Due to undercapitalization, I start paying them 70 rupees per head or even 60 rupees per head. You understood? So I am trying to reduce than the usual payment in the form of dividend to equity shareholders. Got to understand what is undercapitalization and what are the few effects of undercapitalization. Production is halted or production is affected. The credibility of the company is decreasing, and conservative dividend policy. See, at the end, equity shareholders are the owners of the company. If they are not getting maximum benefit out of the company, are they going to be satisfied with the returns? No, right? Definitely they start selling off their equity shares. So therefore, conservative dividend policy is going to be added, is going to be considered as a disadvantage. So we have looked at what overcapitalization can lead to, what undercapitalization can lead to. So what is the answer? Neither we should have over, neither we should have lesser capital. So what is the right type of capital we need to require? We need optimum capital structure, not too much, not too less. Let's plan and let's acquire capital that is optimum. Is that clear? When the capital structure is at that level of debt equity proportion, notice that word, level of debt equity proportion, where the market value per share is maximum and the overall cost of capital is minimum. So what are they talking about? Market share must be maximum and the cost of capital must be minimum. So all of us as investors or as individuals, we need to what? We always plan with minimum cost, let us get maximum benefit. Isn't that our idea normally? Wherever we invest, whatever we buy, we make sure that we are not spending too much, but in terms of benefit, we make sure we get the maximum benefit or maximum return. That is what optimum capital structure also deals with. It says every company has to fix their level of debt equity proportion where the market value per share is maximum. Now, for companies like Infosys, companies like Wipro, where their each equity share price is so high because the demand for that company is so high, the trustworthiness of the company is high, and the employability of the company is good, etc. Because of there's so many added points to it, the market share of that price keeps increasing or it is at the maximum, whereas the cost of capital for raising the same capital is minimum. Okay, so this scenario, this complete condition where market share is high and the cost of capital is low is called as optimum capital structure. When can you achieve this? When can you decide this? Is when you have what? The right level of debt equity proportion. Got my point? Right level of debt equity proportion. So every company has to decide where is that proper level where I can have my debt equity proportion so equal so that I get the maximum benefit from my company. At what time should the debt increase or at what time should the equity decrease is up to the management of the company to decide or make their choices. Next topic is features of optimum capital structure. Now we know what is optimum capital structure. Let's look at 5 different points for which it says features. That means what should the optimum capital structure consist of? How should that be? Number 1, profitability. Now we are all setting up business for what? To make profit, to multiply our money, for our money to grow. Correct? So our capital structure should be framed in such a way that it is fetching profits for us. Okay? The capital structure should generate maximum return to owners. Who are the owners here? Equity shareholders are the owners. So that's why this entire chapter in the practicals part of you will be focusing on EPS, earnings per share. So basically, what is the final return or the benefit derived by the owners of the company? That should be our priority. Second is solvency. What is solvency? Use of excessive debt will affect the solvency of the firm. Therefore, right proportion of debt must be taken. As I told, see here, at that level of debt equity proportion, that is what it's talking about, solvency. Because as I told earlier, if debt capital is more, then you are liable to pay more interest to your debenture holders, irrespective you are making profits or losses. So if you're going to use excessive debt, it will affect my solvency of the firm. So therefore, I need to draw a line or I need to make a balancing point where I need to decide how much of debenture as a part of my capital structure will help me achieve the solvency of the firm. Third point is flexibility. It must allow the existing capital structure to alter according to the changing conditions. Now let's say I have a fixed capital structure which I have decided 5 years back, okay? And now my business is expanding, my business is growing and I would like to have more capital, okay? I want to raise much more capital as a part of my structure. So my capital structure must be flexible in such a way that even if I want to redeem few shares, redeem few debentures or to raise more shares or debenture, it must be possible. What do you mean by redeeming share? That means paying back the equity shareholders or paying back the debenture shareholders, basically closing down their account. Okay, have you heard the word redemption of debentures? That means what? First of all, I issued debenture. That means I took or I borrowed capital from the debenture holder and I'm paying him interest. Opposite, what is redemption of debenture is whatever amount he has invested in my company. Now my company is financially very stable. So what I do, I repay all the principal amount including the interest, pay back to him and close the debenture account. That's called as redemption of debenture. Got it? So flexibility of capital structure means it should be flexible to either raise the capital or redeem the capital according to what? The changing conditions in the industry. Next is conservation. Debt capacity of the firm should not be exceeded. It depends on the firm's ability to generate future cash flows. This is very important. I need to be conservative, means I need to be choosy, or I need to be very careful in deciding the proportion of debt capital to my equity capital. Understand? If I'm going ahead in raising so much percentage of debt proportion as my capital, I should be confident about my firm's ability to generate future cash inflows. That means I must be confident in the upcoming future or in the upcoming years, my company is going to have super profits. Okay, my company's products is going to be a hit in the market, or my company's services are going to be satisfying the customers or clients, etc. I need to be confident my business will click, my business will boom, and therefore I'm going to have future cash inflows. So using this cash inflows with that confidence, today I am able to raise my debenture. Okay, so I need to be conservative, means I need to be choosy, or I need to be calculating my risk and my firm's ability both in hand. The last point is control. Use of more equity may lead to a loss of control of the company. It must not lead to dilution of control. Understood? Now, control here I am talking about is the decision making power. Controlling here is decision making power. Now, we also have looked at how to for one of the internal factors affecting the capital structure is control over company's affairs. Do you remember that point? Control over company's affairs. This is what I'm talking about. Okay, so if I'm going to have more equity shareholders, my decision making is going to be affecting. At the end of the day, whatever the company is performing, how it is performing, all depends on the decisions made in the board meeting. Correct? Decisions made in the board meeting or by the shareholders. Now, depending on whether the decision was right or wrong, the company will perform correctly or accordingly. Correct? So, therefore, the decision making or the controlling power should not be diluted. That means it must not be affected negatively. Understand? So, I need to, if I want to make sure my control or the control over the company's affairs must be not diluted, or I must not lose the control of the company, then only to a certain limit I will raise equity, not more than that. Understand? Only to a certain proportion I am going to raise equity, and then for the remaining capital I will go for debenture. Why? Because debentures are nowhere connected with the decision making power of the company. They only want the interest on their debenture. Is that clear? So the fifth point talks about control aspect. So today we looked at the sources of finance, three sources: short term, medium term, long term. We looked at what is overcapitalization and the effect, undercapitalization and the effect, what is the optimum capital structure, its meaning. We looked at 5 features: profitability, solvency, flexibility, conservation and control. So today we are going to begin our third chapter called as financing decisions, and first and foremost we need to remember the format of income statement. Let's look at it. So it always starts with sales. So where does our income come from? For every company, it is through the sale of products or services. So the amount of sales that you make or the amount of revenue that you earn out of your sales is called as sales revenue or profits, from which your first thing you're going to deduct is variable cost. So variable cost, once you deduct, you end up at contribution. So sales minus variable cost is contribution, minus fixed cost. Fixed cost is anything that is fixed irrespective of the output of production. A variable cost changes with the output of production, number of units of output, whereas fixed cost expenses do not change. For example, rent. Right? Rent of the building you have to pay irrespective of you are conducting a production in the building or not conducting production. It is a fixed payment. Variable cost, say for example your labor cost. When you're producing 10 units, you need just maybe 5 laborers. When you're producing 100 units, your quantity of labor or the amount spent on paying the wages will be increased. So that is called as variable cost. So sales minus variable cost, you arrive at contribution. Fixed cost, from contribution, when you deduct fixed costs, you arrive at operating profit, or otherwise called as earnings before interest and tax. So these are your basic expenditure. Once you deduct from your revenue or sales, you end up at operating profit. So many times questions give you the operating profit of the company is. They wouldn't tell you directly EBIT, but they give you as operating profit. So you need to remember operating profit is otherwise called as earnings before interest and tax. So from EBIT, I first need to deduct my interest on debentures. In case the company has debentures and which you have to pay interest to them, that will be deducted. Only the interest payment will be deducted. So then it will be called earnings before tax. That means you have paid the interest but you have not paid the tax. That is called as EBT, earnings before taxes. Next, income tax. So after paying interest, you're going to pay taxes to the respective government. So it is called as earnings after tax, EAT. And then preference dividend. So if in case the company has preference share capital and so it has to pay preference dividend, that will be deducted here, only the dividend amount. And then so the final, after all the bills to be paid, interest to be paid, expenses to be set off, what you arrive at the final product or the final answer is called as earnings available to equity shareholders. I repeat, it's called as ESH, otherwise earnings available to equity shareholders. It is out of this final amount that equity shareholders are going to get a part as dividend, only the equity shareholders. Then further, now this amount is a total lump sum amount available to equity shareholders. I am not talking about particularly per head equity shareholders how much is going to earn. Per head I am not talking about, it's just a lump sum amount. So how do I know per head how much each person is going to get? Then I need to know the information, number of equity shareholders or number of equity shares. So depending on number of equity shares, I can find out earnings per share, that is otherwise called as EPS. So earnings divided by number of equity shares, then you will get the proper amount or the amount per head to be paid as dividend to equity shareholders. Hope you have understood the format of income statement. Starting from sales or revenue, you deduct variable cost, you arrive at contribution. Then you deduct fixed cost, you arrive at EBIT. You deduct interest on debenture, you arrive at earnings before tax. You deduct income tax, you arrive at earnings after tax. Then you deduct preference dividend. The final thing you come across is earnings available to equity shareholders. It's a lump sum amount available. If you want to know per head how much it is available, divided by number of equity shares, which is called as earnings per share, EPS. So then you will arrive at earnings or dividend available to per equity share holder. So your next up topic is leverages. You need to understand this basic concept. It's a 6-marker, section B topic, leverages. So we need to understand the 3 different types of leverages. The first one is called as operating leverage, where the formula stands OL equals to contribution divided by EBIT. Now how does contribution arrive? Only when you have paid off your variable cost. Sales minus your variable cost, you actually arrive at contribution. Contribution minus your fixed costs. Just now we discussed the format, right? So contribution minus your fixed cost, you arrive at EBIT. So here we are actually discussing about the amount of risk, that is the business risk the company can take up. When if I say my operating leverage of a particular company is good, that means I'm talking about the company's capacity in meeting the business expenditure, or either in simple, even in a simpler format, how the company is able to run its production process without much hindrance or without much hindrance or problems. That is called as operating leverages. That means you're able to avoid any kind of businesses. Your business is able to run smoothly because you're able to pay off your number 1 variable cost and number 2 your fixed cost. So operating leverage is going to check the basic functioning of a company or a business. Your second leverage is financial leverage. The formula stands for FL equals to EBIT divided by EBT. Here, as the name itself says, financial, right? Now here I am going to talk about my financial capability or my repayment capability. How does EBIT occur? When I deduct fixed cost from my contribution, correct? How does EBT occur? When I deduct interest of debenture from my EBIT. Then only I arrive at earnings before tax. So here the point of difference is interest on debenture payment, which is very prominent for a companies to talk about their repayment capability. Borrowing is easy, but are you able to repay them? Are you able to give them back the earnings that you promised them? Now, every time you're issuing a debenture, there is a percentage that you promise them, correct? 10% or 12% on the face value of debenture. Now, is that 10% being able to make the payment by the company is what I'm checking in financial leverage. If not, what if the company fails to make the payment? The debenture holders have a legal right on the assets of the company. So they can simply sell the assets of the company and get their money back. Basically, it's going to affect my company's reputation, it's going to affect my company's business production, etc. Right? So here my second leverage is talking about my financial capability or my repayment capability. The last one is a combined leverage. The formula stands for CL equals to contribution divided by EBT. Now here, since it's called as combined, I'm going to combine both the risks, my business risk and my financial risk, both. Combined, I'm going to combine my business risk along with my financial risk and call it as contribution divided by EBT. So these are your three different leverages asked for your section B format in your question paper, called as operating leverage, financial leverage and combined leverage.